In this video, I want to talk about a model. It's a combination of several different kinds of techniques, I guess, but it utilizes a little bit more information to try to develop a concept of what's going to happen in the future cash flow wise for a company. So let's start with a company where we're going to start in the year 2014, right? So we know that this is the year we're in right now. So we got 2010 through 2014, and we need to gather some information. So we have gathered the earnings per share for the last 5 years. So here we have our earnings per share. We've also gathered our dividends per share. And from that information, we can then calculate the dividend payout ratio. The calculation that follows this then is an average dividend payout ratio and an average earnings per share growth rate. Where we can plug these numbers in is we can plug those numbers in the data position over here. So under estimated dividend payout, we're just going to assume or round up to 34%, and we're going to keep the earnings per share growth rate at 4.437%. Now we can certainly adjust either one of those for information that we learn along the way about this particular company. Of course, we're also going to need to plug in the current earnings per share of $3.45. The other piece of information we need to know to get started here is what is the company's required return. We can use the security market line where we can look up the risk-free rate. In this case, is 3.29%. The beta of the company is 1.25, and the average stock market return that we're going to use is the average for, large company stocks. We could use any number between probably 10 and 12. I used 11.5. So the required return here is 13.553. Again, we plug that number in here. What this does for us now is it gives us some calculations that we can take that we can use to figure out something about dividends, and then ultimately use a multiplier model to determine what we might find for a price of a stock later on. So let's revise the information we know. We want to calculate or forecast the next 5 years of earnings per share and therefore its dividends, since we know the average dividend payout ratio, and then we want to calculate the present value of those dividends. The discount rate that we're going to use is the required return for the stock. So this is the present value of dividends for years 2015 to 2019 using 13.553% as the discount rate in the time value calculations. If you add those up, it says that the present value of our estimated dividends is going to be $6.70 for the next 5 years. That's the value in today's money. The other calculation we need then is we need to figure out what the price is going to be at the end of this 5th year. Well, we know what the earnings per share is going to be. We forecasted that to be essentially $4.29. We need to have some kind of a forecast of the PE ratio. If I could find a forward PE ratio for 5 years, I might want to use that number. That would be a good number. But in general, I just need to know, what do I think the value, how do I think shareholders will be viewing this company 5 years down the road? Again, that's a very, very strange kind of a forecast. And certainly it's not going to have a lot of reliability in it. But we need to understand, maybe we want to start with just use today's PE ratio. So I have a number of 18.5 here. Maybe in the end we want to do a range. What would happen if the range of the PE ratio was from 16 to 20? In fact, we'll look at that here maybe in a second. But 18.5, we forecast the price will be $79.30 5 years from now. The present value of that in today's money is $42. So if you add the present value of the dividends and the present value of the stock, we could end up with a value today of around $48.70. So that's the most you'd be willing to pay for it today. Well, what if the PE ratio is as low as 16? Then the value of the price would drop as low as maybe $43. What if the PE ratio was high as 20? Now we're up as 52. So we have a number between 43 and 52. So let's go back to where we were. We were at around 18. Let's just kind of go back to get the exact right number. It was 18.5. Hey, what if we say, earnings per share, the company might have a little bit of a slowdown. It's going to be a little bit tougher. So maybe earnings per share is only going to grow at 4%. Now we have a stock price around $47. Things are going really good. We're going to buy a new company. Earnings per share is expected to expand dramatically. So maybe we're going to have a 7% growth of earnings per share. Now we're back up to $54. So we can use the information that we have and do a little scenario analysis, get a range of stocks where we think they might, where that ultimate range might be. Maybe we could create some data tables to have to show the range of prices at various PE ratios, variable earnings per share growth rates, and we can look and see what the values, what the range, what the locus, if you will, the high point, low point, what that might be for the stocks. But this is just a vision, if you will, of how you can utilize the concept of the dividend discount model, which is in this case really the supernormal growth rate model, and how we can also utilize a multiplier model to help us look a little bit deeper into some of the factors that affect stock price.